five assets. Millions of people own them. And historically, during major economic resets, these are the exact ones people regret holding the most. Number 1 on this list? It's probably sitting in your portfolio right now. Here's what history actually shows. And right now, some analysts believe the early warning signs are starting to appear again. Not loudly, not dramatically, but quietly enough that most people still ignore them. Quietly, gradually, the same way these shifts usually begin. Stay with me. Because by the end of this video, you may look at your portfolio very differently. First, we need to understand something important. What exactly is a dollar reset? In simple terms, it's when a currency rapidly loses purchasing power, causing savings and assets tied to that currency to lose real value. History has seen this before. In Weimar Germany during the 1920s, inflation spiraled so fast that everyday prices changed almost hourly. In Zimbabwe during the late 2000s, hyperinflation became so severe that trillion-dollar banknotes eventually became worthless. Now to be clear, the United States is not Weimar Germany. But the reason economists study these periods is because major currency instability tends to leave warning signs before it happens. And historically, most people only recognize those warning signs in hindsight. And some analysts believe several of those signs are now appearing again. Not necessarily pointing toward collapse, but toward instability. And historically, instability changes behavior long before it changes headlines. But before we get into the 5 vulnerable asset categories, you need to understand the biggest mistake most people make during financial cycles. Because this mistake changes everything. Here's the mistake most people make. They react too late. Historically, major market moves tend to happen before the average person realizes conditions have changed. By the time fear reaches headlines, smart money has usually been repositioning for months. That's why experienced investors spend more time studying patterns than headlines. Not because they can predict the future perfectly, but because history often rhymes. And that brings us to the first asset category. Asset number 5. Long-term government bonds. For decades, bonds were considered one of the safest investments available. But during periods of persistent inflation, their purchasing power can quietly erode over time. During the inflationary 1970s, many bondholders saw significant purchasing power decline over time. And today, concerns about inflation, interest rates, and government debt have brought bonds back into the spotlight. Now, to be fair, this doesn't mean bonds are bad. It means that in certain economic environments, they may behave very differently than people expect. But asset number 4 surprised even me. Asset number 4. Highly overvalued real estate markets. Real estate has historically created enormous wealth. But timing matters. In 2008, many housing markets experienced sharp corrections after years of aggressive price growth. And today, in some cities, price-to-income ratios remain historically stretched. Now that doesn't mean housing collapses tomorrow. But it does raise an important question. If affordability continues weakening, how sustainable are current prices? Because prices can stay high for a long time. Until suddenly, they can't. And that leads directly into asset number 3. Because this next category directly affects the thing most people trust the most. Their savings. Asset number 3. Holding excessive cash in a single currency during high inflation periods. Now this sounds counterintuitive. Because cash feels safe. But historically, inflation slowly reduces purchasing power over time. Meaning someone can spend years building savings, only to realize those savings buy less and less every single year. And the dangerous part? Most people don't notice it happening until years of purchasing power are already gone. In countries that experienced severe monetary instability, access to savings sometimes became restricted or rapidly devalued. Argentina is the clearest modern example. Between 2001 and 2002, the government froze bank accounts. Ordinary people couldn't access their own savings. When accounts finally opened, The peso had lost over 70% of its value. People didn't lose money because they were reckless. They lost it because they trusted the system, and the system changed the rules. That's the uncomfortable part about cash concentration. It feels safe, right, until it doesn't. Again, that doesn't automatically mean the same outcome happens everywhere. But it explains why diversification becomes an important conversation during uncertain periods. And we're only halfway through. Because the next two categories are where this conversation becomes truly uncomfortable. And one of them is probably sitting in a lot of portfolios right now. Asset number 2. Highly speculative technology stocks with weak underlying earnings. History has seen this before. During the dot-com bubble of the early 2000s, many companies reached extreme valuations despite limited profitability. When sentiment shifted, the Nasdaq fell dramatically over the following years. And today, some analysts argue portions of the market once again show signs of excessive optimism. Now, this doesn't mean technology is doomed. Far from it. But historically, assets priced for perfection can correct brutally once economic conditions tighten and expectations collide with reality. And now we reach the most controversial category of all. Asset number 1. And arguably the most sensitive category of all. Retirement accounts heavily concentrated in a single currency system. Now this is where the conversation becomes controversial. Because for millions of people, retirement accounts represent decades of hard work. And historically, most diversified retirement investing strategies have worked very well over long periods of time. But economists also study what happens during periods of major currency instability or structural economic change. In some countries throughout history, retirement savings lost significant real purchasing power during inflationary crises. Not because people made reckless decisions, but because the economic environment changed faster than expected. And historically, systems rarely warn average people before repricing their future. And that's what catches people off guard. Not because they ignored risk, but because the rules changed underneath them. Again, this is not a prediction. It's historical context. And whether you agree or disagree, it's a conversation more people are starting to have. So what can people actually learn from all of this? Not fear. Preparation. Historically, periods of uncertainty rewarded people who stayed flexible, diversified, and informed. That's why many investors study hard assets, international exposure, and multiple income streams during uncertain periods. Not because they know the future with certainty, but because resilience matters. Because during uncertain periods, survival is rarely about being perfect. It's about not being unprepared. And look, I could be wrong about the timing. Many analysts disagree on what happens next. But the historical patterns we discussed today? Those patterns are real. And historically, the people who understood them early were usually the ones least shocked later. If this video changed the way you think about financial risk, subscribe my channel if you want more breakdowns like this. My next video answers the one question this video raised. If these 5 assets are vulnerable, then what actually holds value? The answer might surprise you. Subscribe, because that video is coming next. And if you watched this far, you're already ahead of most people. The question is, will you stay ahead?